Welcome to Industry Focus, a podcast that dives into a different sector of the stock market every day. It's Friday, May 4th, and we're talking Snap and Apple earnings. I'm your host, Dylan Lewis, and I'm joined on Skype by senior tech specialist Evan New. Evan, it's May 4th, and I guess as a tech show, we have an obligatory nod to May the 4th, the Star Wars movement.
Oh, yeah. It's Star Wars Day.
It is Star Wars Day. I'm not a huge Star Wars fan. Are you?
I'm kind of. I mean, my wife is big into it just because her name is Leia, and she was named in part because of Princess Leia from Star Wars. So she has a special, bond with Star Wars.
Yeah, we have a lot of other writers on Fool.com that are far more into it, namely Dan Klein. So maybe next year I'll have him on the show and we can do some kind of Star Wars Disney stuff. But today we are going to be talking instead about one company that you and I both love and one company that we love to follow. That is Apple and Snap. Why don't we start out talking about Snap? The company released earnings earlier this week. Revenue was $231 million. Wall Street was expecting $245 million. Some disappointment there. That's 54% year-over-year growth on the top line. And of course, on the bottom line, the company lost money. Not surprising, given that they're in growth mode. The narrative with this company, though, has really been user-focused, I think, specifically over the last quarter. A lot of concerns about what this redesign with their app might do to user retention and to engagement. Looking at the numbers, it seems to have had an impact, Evan.
Right. Like Snap went public so early in its lifetime relative for companies that go public. So I think that's why investors are so focused on this user aspect. I mean, much more than most social media companies in general, just because it's, their ad business is so young that it really does revolve very heavily around how the user base is responding to these types of changes. And there's been a lot of controversy over this redesign. And, celebrities have been bashing it. You've had social media hoaxes go viral saying it's going to come back. You've had online petitions, like all sorts of backlash. And, CEO Evan Spiegel has kind of defended it. But now what we're seeing is that it's really having a very noticeable and quantifiable impact on these metrics. So daily active users came in at 191 million, which is up just 2% sequentially from the fourth quarter, which is their lowest sequential growth rate they've ever posted. So, I mean, that number speaks for itself.
Yeah, and I think importantly, management noticed that the average in March, this is a daily active figure, was lower than the overall Q1 average. So there's probably some drop-off happening there that's tied to either the redesign or some performance problems that they were running into on their Android app. If you're trying to work through exactly where the number stands and how big that drop-off was, management noted that the March average was above the 187 million daily active users that they posted as of Q4. So, they're hoping to right the ship with fixes to Android and to the tweaks and kind of maybe walkbacks on some of the changes that they've made in the app. But that is not a trend that you want to see, particularly for a company that was essentially pre-monetization, about a year and a half ago.
Right, exactly. And, I think that, so they're testing out these different versions of it. They're really still committed to this idea of, separating your social content from your friends versus professional content from media publishers, which, makes sense in some ways, but, it is starting to weigh on the financials. And I don't think they're going to go back to the way it was before because, they're very committed to it. They just want to kind of tweak it and find the right balance. But, how's the user base going to respond to all these kind of constant changes? Whereas Snap clearly doesn't really quite have a very clear vision on what it wants. So they're still testing it out, but I don't know.
Another thing that really spooked the market was a forward-looking comment from CFO Anthony Valero. And I think that this is Andrew. Sorry. Thank you. Thank you for that correction. Snap is not a company that is known for giving guidance. And so when we do get anything that is kind of forward-looking from management, I think people tend to kind of their ears perk up. And on the call, the CFO said, as we think about year-over-year revenue growth rates, we are planning for our Q2 growth rate to decelerate substantially from our Q1 levels. And I think to help paint a picture of what growth has looked like for Snap over the past few quarters, we just said before, 54% year-over-year growth in Q1 of 2018, Q4, 72%, Q3 of 2017, 63%. So for them to be saying that we're going to have a meaningful deceleration as a cue to analysts, they must be expecting a pretty decent drop somewhere in like the low 40s or perhaps even lower.
Right. And I think the broader context to these kind of relatively strong historical growth rates is that, remember, as we mentioned, this ad business is so young that they're coming off a really small base. So these growth numbers look really good, but you would also, you would expect them to keep maintaining these high levels of growth, which are, by the way, being priced into the stock. At least they were before the earnings release. But you have these high growth rates as you're growing off these really small bases. So some deceleration is expected, but when they're expecting a big drop off, even when they should still be in the process of ramping, like that is a pretty big concern for investors.
And they point out that this deceleration comes as there's a lot of growth in ad impressions, which are being offset by pricing for Snap ads. And I think to a certain extent, this dynamic is bound to happen. With the switch over from these direct sold ads to programmatic, where you have kind of software being used to buy ads rather than having contact and salespeople, there are a lot more fluctuations with ad prices. The flip of that is it opens the door to a lot of new advertisers to come in. And so this is a move that we've talked about in the past that Snap really had to make, especially in order to bring smaller advertisers into the fold. But this is the problem with making that switch, is that you can have some pretty big hits to your financials if you're wholly reliant on ads.
Right. And I think Chief Strategy Officer Imran Khan had an interesting comment too about, as this redesign relates to ad buyers, specifically, there's been so much negative press about this redesign that he said that that's probably causing some delays or pauses in purchase decisions, which is probably true, but it's also kind of like you're blaming it on the media. But the point is that this redesign is not really getting well received from the user base, and that's going to manifest in the ad business too.
Something that has gotten a ton of media coverage and was curiously absent from the conference call was Snap Spectacles. The new version of their hardware product. I've read so many articles talking about this new product launch, and yet no analyst questions about Spectacles and nothing from management kind of touting that they're really excited about this new product line.
Yeah, for a camera company, right? "Quote unquote" camera company, making their second generation hardware. I mean, I think analysts realize that their hardware has always been this tiny part of the business, so they're more focused on the ad business and things there. But I was surprised that maybe even in prepared remarks from the management, they didn't mention it, which is it is a little weird because they're kind of trying to pin their future on their ability to pivot into camera hardware, and I think that's pretty misguided because they don't even have their core ad business down. And besides that, I mean, the second generation Spectacles, they're not really anything game changing. They're just kind of minor improvements from the first one. And the first one was such an utter disaster and a flop. And, they ate this $40 million inventory charge last year. It clearly did so poorly that you would think that Snap would realize that they need kind of a bigger overhaul of the product to make it more successful. But instead, what they did is they increased the price of it to $150. And basically just made some minor incremental small improvements, a little bit thinner, a little bit lighter, small, performance improvements, but nothing enough that really addresses kind of why the first one failed in the first place. But
yeah, I get that they have bigger fish to fry, but as an analyst, kind of understanding that 10, 15 minutes into the call, a lot of the core questions have already been asked. I'm shocked that no one said, hey, can you talk a little bit about the inventory management that you guys are doing for the Spectacles line now that you're relaunching it? Because, you did eat $40 million in charges last time around. And we just like to get a sense of, how you're handling it this time around.
Yeah, did you learn anything? I mean, that's a pretty very reasonable question to ask, even beyond just kind of detailed stuff. Just, hey, what did you learn from it? And what are you going to do next time? The very strategic question. But I was kind of surprised too. They didn't really talk about it.
Yeah, looking kind of broad at this business and what we learned from this conference call and this earnings release, I think so much of what Snap's management is saying sounds right kind of at first glance. The move to programmatic was absolutely the right decision for the business. And management, to kind of compensate for this deceleration in revenue, has talked about this narrative of, we're not playing the pricing game to maximize short-term revenues. And that sounds like long-term thinking that we normally love. I don't know that it holds a lot of water. I think in some ways it's kind of more window dressing than maybe how they really feel about their business, though. I went back and looked at Facebook's early calls, I think just as kind of a reminder of what happens when these companies go public, what is the scrutiny that they go under, and what are people focusing on. And the two things I was curious with, Evan, was ad dynamics and growth rates. And generally speaking with Facebook, I know the monetization timeline was a little bit different for these two businesses. Ad prices were kind of up and to the right, even early on for Facebook. And there were times where they intentionally did things to lower ad prices. They lowered the price floor in some developing markets to make ad buys a little bit more accessible to advertisers. But even when they did that, the company posted overall price growth because demand was so strong in North America. And so I think that's something to kind of keep in mind when, they're saying that this is a reflection of programmatic. Yes, it is. But if we don't find a floor for this fairly quickly, I think it's kind of a broader reflection of how interested people are in reaching people on Snap and the ROI that they get on advertising on that platform.
Right. And another example to your point about, them saying stuff that sounds like it should be right, but in reality isn't really what's going on. I want to point out something in the earnings slides. They have this line, and we've talked about the cost structure quite a bit on the show, but they have this line saying, quote, modest capital expenditures result in stronger free cash flow conversion over time. And that is technically a true statement. But in the context of Snap, it comes off as like a parody or a satire because it's just a joke because, their capital expenditures are so low because they outsource all infrastructure and cloud hosting to third-party providers, which is, as we've mentioned, is a really short-term strategy. But it was really hilarious. And that line's always in their slides. But this quarter in particular, it was pretty hilarious because their free cash flow dipped to the worst level it's ever been. And when you see that line below this chart that shows free cash flow just falling off a cliff, it's just kind of like, what are you even talking about? So free cash flow is deteriorating. And it was negative 268 million this quarter. And that's largely because operating cash flow is just getting worse too. Operating cash flow was negative 230 million or so compared to negative about 150 a year ago. So, these numbers are getting worse and worse. And then they have this line that, again, it sounds right. But when you look at the numbers, it just doesn't apply to that.
Yeah, and I know that this is a business that we have been, pretty bearish on throughout the time that we've covered it. I think to paint a somewhat rosy picture or give the alternate side of things, kind of going back to this Facebook example I had before, there were plenty of times early on where Facebook had year-over-year revenue growth decelerate quarter to quarter, and then the company found growth and re-accelerated. And that happened because they had user growth, they had growth in their ad inventory, and ad prices continued to climb, which is to say that it is not doom and gloom for Snap necessarily. But if you're only looking at what's going on with revenue rates. But when the other metrics aren't also trending in the right direction, I think it doesn't look very good. The idea that user growth on a sequential basis is as low as it's ever been, that's problematic. I think that, the possibility that within the quarter they had their lowest user counts in the most recent month is not a particularly great sign either. And you talk about kind of the social and pop culture elements that they have to overcome with getting advertisers on the platform. There just seem to be a lot of obstacles in front of this business right now.
Yeah, I kind of regret closing out my puts a couple months ago.
Thank you for that note of transparency. Yeah, neither of us have any active positions in Snap now, but there was the case where you had something going on there for a little while.
I made a little bit of money.
We're going to talk about something that you and I both own. We're going to talk about Apple and their earnings report on the second half of the show. All right, Evan, on to one of our favorites. I think we've skipped a couple quarters here and there with Apple, but this is a business that we generally love to cover. A couple different reasons. It's a fun company to talk about. It is one of the world's largest. And whether people realize it or not, almost everyone has a stake in Apple because it is such a large component of the major indices out there. Why don't we walk through what they reported on Tuesday and some of the headline numbers?
Sure. So revenue was up 16% to about $61 billion. Net income up 25% to about $13.8 billion. Earnings per share up 30% to $2.73. And you can see a disconnect there between net income and earnings per share because Apple's so aggressive on the buybacks, and a lot more of those earnings are accreting to individual shareholders on a per share basis, which we'll talk more about the buyback program later. iPhone units were up about 3% to 52-ish million. iPhone revenue is up 14% to about $38 billion. And a lot of that is due to iPhone 10 and its $1,000 price tag. And Tim Cook did note on the call that this is the first product cycle since 2014 when they kind of introduced the two different sizes, 6 and 6 Plus back in 2014. This is the first product cycle since then where the most expensive iPhone has also been the most popular. So we're seeing a lot of uplift in terms of average selling prices, and that business just continues to perform very well. And we're seeing Apple actually reaccelerate on the top line a little bit, which is not an easy thing to do when you're talking about a company of this size.
Yeah, you teased this a little bit. The number that stood out to me with this was 100 billion. And I mean, it looks to me like Apple is going to be buying back some more shares over the next couple of years. That EPS number is probably going to continue to climb.
Right. So, of course, the big thing to thank here is tax reform that was passed last year. And, as many people have expected, that a lot of companies would use these tax savings, not necessarily for stimulate the economy. Of course, some of that will be there too. But a lot of companies are really allocating a lot of these tax savings towards share repurchases, which, as investors, we like a lot. So they repurchased over $23 billion in stock last quarter, all in open market purchases, which is a big sequential spike, and all thanks to this tax reform. And they expect to complete their current $210 billion authorization during the June quarter. They spent about 200 or so over the past 5 or 6 years, which is kind of a mind-blowing figure in itself. And after that, they'll have about 10 billion left. So in the June quarter, they're going to finish that off and then start on this brand new program that they announced that you mentioned, the 100 billion, which is another humongous number. They're not pinning that on any specific time frame. They're just saying they're going to be fast and efficient with it, but didn't really specify exactly when they expect to do that all by.
And it's really kind of hard to argue with the success of the buyback program for them, because if you look at Apple's stock chart, I mean, this is a company that has generally been up and to the right with few exceptions, over the past 5 years or so. So it is not as if management has been buying back shares and then seeing the price fall dramatically and, been bad capital allocators. They've very opportunistically bought back shares and done quite a service to shareholders by doing it.
Right. And by all traditional valuation metrics, Apple's super cheap. It's hard to compare against other companies because they're so large in terms of their size. They don't have a lot of peers that are bringing in as much money and as profitable as they do. But they have been very focused on buybacks. And even on the call, CFO Luca Maestris admitted that, yes, Apple is very, quote, biased towards the buybacks because it's so cheap and because they still think it's undervalued. So even though they're also increasing the dividend by 16% or so, which is a nice little boost for income investors, they're still really heavily focusing on the buyback piece, which is better to drive up earnings per share over time as you can retire a lot more shares. And they're not they're not just buying these to offset dilution from ongoing compensation. They've retired so many shares over the past years that investors are really getting a tangible benefit from that.
Looking at some of the smaller parts of the business, Evan, what's going on with wearables right now?
So wearables, which Apple defines as the way Apple defines, includes Apple Watch, wireless Beats, and AirPods, which is kind of, in my opinion, a dubious definition because wireless headphones, I don't know if that's what most people think about when they think about wearables, but for what it's worth, that's how Apple defines it. And they're saying it's up almost 50%. They still don't disclose a dollar figure for it, but these products are pretty much driving almost all growth in the other products category. They said over 90% of growth was because of these wearables, which they also mentioned is now the size of a Fortune 300 company, which is Apple's way of saying that it's close to a $10 billion business for them, which is pretty impressive, considering the fact that they only got into wearables, in 2014, starting with Apple Watch.
That is one of my favorite things to see in Apple's conference calls is the different ways that they refer to the scale and size of these tiny business operations for their purposes. The idea that wearables is the size of most companies or larger than most companies. They do the same thing very often for their services segment. And it looks like growth was really strong there, too. This is one I'm particularly happy about as a shareholder because it's a high margin business for them.
Right. So revenue and services was really strong last quarter, up 31% to about $9.2 billion. On a trailing 12-month basis, services is now a $33 billion business for Apple, which is huge and it's much more profitable than the corporate average typically. And that's being driven by, now they have 270 million paid subscriptions going through all of their kind of digital storefronts. And that means they've added over 100 million in the past year alone. And just shows you how well they're executing on growing this business after they set out this goal, a year or two ago that we're really going to try to double this business. And these numbers really show that they're making a lot of progress. They're on target to hit that.
And this becomes increasingly important for the company as we get closer and closer to, like a smartphone saturation and perhaps this concern about slowing upgrade cycles for these major phones as average selling prices get larger. The fact that they can build out this nice kind of high margin services segment is a nice way for them to continue to make money off of that base.
Right. And, within services, those subscriptions, you have Apple Music, which is now at about 40 million. You also have iCloud Storage, which is technically billed as a subscription. Those are Apple's two main first-party subscriptions. So if we say iCloud Storage is probably 30 million or less, then that means third-party paid subscriptions are probably over 200 million. And remember, Apple does very little for those third-party subscriptions. It gets like a 30 to 15% cut, depending on how long that subscription has been in place. They're getting a pretty nice cut on that, even though they're not doing a whole lot. So that's pretty profitable, revenue getting their cut on those subscriptions. And on top of that, there are reports that Apple's planning this premium news service since they bought Texture earlier this year, which is a digital magazine service. And I think that could really build on this momentum that they're seeing because Apple News is already a very strong service and has a lot of users. And if they can, introduce this new premium service for news, not only do they benefit, but also all of their publishing partners will benefit too. So I think that sounds pretty promising to me.
One thing I was a little surprised to see in this earnings release was a pretty big spike in inventory. We know Tim Cook as this guy who is a supply chain master. That was kind of his MO and his reputation coming into the CEO role. And it's something that Apple has very tightly managed for a really long time. We see that it spikes to over $7 billion, the highest ever. What is going on with their inventory right now?
Right. So Tim Cook has this famous line that he considers inventory to be, quote, fundamentally evil. And just because, over time, if you build too much of it, it gets written down and it's just a mess to deal with. So it's very good to have, you want lean inventory, enough to meet demand, but not too much on your books, which is why this spike was so weird. But it's really just actually component purchases. An analyst was able to get some clarity on that because I noticed it too initially when I saw the balance sheet. And basically, CFO Maestri said, we're basically making these purchasing decisions because of current market conditions. So they're basically just pre-buying all of these different components because the components, most specifically memory, the pricing is supposed to continue going up. I mean, it's been going up for 2 years and it's probably going to keep going up. So they're basically just trying to buy as much as they can now to get ahead of continued price increases later this year. And as we all know, they release a ton of iPhones in the fall, and they're going to need all those components to put them in their phones. So very specifically, the type of inventory that we're talking about is really just components. It's not like unsold products on shelves, which would be a pretty big concern there if that were the case. So it did jump out at me too, but that's what's going on there.
So this is more of a planned decision than them sitting on stuff in a warehouse.
Right, exactly. And, he was like, it'll unwind itself over time. So really nothing to be concerned about, even though the numbers look a little scary.
One other little tidbit from the call and from the release that I think is interesting, to go back to the conversation we were having about Facebook when we talked about their earnings, we both kind of expressed some surprise at seeing a company have Forex that was accretive. Usually when you have money that you're bringing back from overseas, from foreign operations, and you're bringing it to the United States, because the dollar's been so strong for such a long period of time, that winds up being a ding on your top and bottom line. That was the case with what we saw here with Apple, where they wound up taking a slight hit for that.
Right. So that was kind of the opposite scenario here, because Facebook doesn't really have much of a hedging program in place to accommodate for these FX movements, and which is why they got this benefit as the dollar continued to weaken. Whereas Apple, is much larger and obviously has a lot more money on the line, and generally just their business is much more spread across the world in terms of their supply chain. So they have a much bigger and more active hedging program that kind of mitigates these foreign exchange movements both up and down. So I mean, they've tried to do their best to mitigate these hits that they've taken while the dollar was strengthening. And now the dollar is weakening. They're kind of missing out on the upside because these hedges are in place. So it was kind of a funny thing, but it's because Apple does such a good job in general. Because, I mean, if you're a company, you just don't want the risk at all. You just want to hedge it. You don't want to deal with, you're not a currency trader, right? You don't want to ride the swings up and down. So they just try to hedge it to kind of mitigate all risk up and down. So yeah, they didn't get to enjoy some of it like other companies.
Coming into this quarter, I think there were a lot of concerns surrounding Apple. You know, there were a lot of people kind of reading the tea leaves on what they were getting from various points in the supply chain and saying, oh, you know, we're not seeing the demand that we thought we'd be seeing for these really high-priced iPhones. It seems like those concerns were overstated, to say the least. Looking at Apple, you know, over the next year, 2 years, 3 years, what are you seeing in this business? You know, we're both shareholders. I kind of feel like I'm sitting on my shares that they will not be this massive growth company like they have been perhaps over the last 5 years, but that there, you know, is nothing wrong with owning them, especially if you're looking for some pretty low risk exposure to the tech space.
Right, and that's exactly how I view it too. Like, I don't have huge expectations in terms of capital appreciation. The income's nice. I'm not really an income investor, but I'll take it. I'll reinvest the dividends. Nothing to complain about. But I also view them as a pretty safe play because, you know, as we mentioned before, their valuation numbers are so low and they make so much money that they're not going to be super volatile. And I mean, I've been overweight Apple for many years just because I've had it for so long. But I'm just going to hang on to it. I'm not going to have huge expectations about it jumping through the roof. But I mean, right now it's kind of like this race to $1 trillion market cap because all these tech companies are having, you know, pretty strong results. And big question is, can Apple get there first? Which is only like, you know, 10 or 11% up from here. So it's not like a huge gain, but it'll be a milestone if and when it comes.
And listeners, if you want any more Apple coverage, Evan is one of our best. He's written the classic earnings take, but he also has some more deep dive stuff from the call and some things that maybe aren't covered quite as much. So if you want any of that news, just write in and we'll make sure that you get it. Evan, anything in particular you want to plug on that Apple coverage?
No, I think we're good.
All right. That does it for this episode of Industry Focus. If you have any questions or if you just want to reach out and say, hey, you can shoot us an email at industryfocus@fool.com. or you can tweet us at MFIndustryFocus. If you want more of our stuff, subscribe on iTunes or check out the Fool's family of shows over at fool.com/podcasts. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against stocks mentioned, so don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for all his work behind the glass. For Evan New, I'm Dylan Lewis. Thanks for listening, and Fool on.